All right, good afternoon, everybody. Chris Lester here, your speaker. I want to thank each of you for taking time out of your busy schedules to join us here. I've been doing these for 18 months now, and I get a lot of positive feedback. I actually enjoy bringing fresh and new content each and every week. For those of you that have not been on this call before, nothing's going to be sold here. We're firm believers of educate first. There's a lot of financial information out there. Sometimes it can be overwhelming. And then we hear things and what should we do, shouldn't we do? So I started when COVID hit, created a format that allowed me A, to stay in front of you on a regular basis, and B, for me to share some of the in-depth content that's in the financial services industries on a weekly basis. And we're going to change that topic up from week to week, month to month. And again, if you have any topics that you'd like to hear more about, and it's something that's within my wheelhouse and the ability to convey, I would welcome the opportunity. So the title of this week's presentation is Gold, a Diversifier. Notice that the title is not gold, put all your money on it, right? Gold, the only asset you should have. The word a diversifier is a very important element of portfolio development, and as you're going to see here in a second. Some of you may recognize this chart. This chart was how 2020 ended up, and every month I would do a behind the scenes Monday day quarterback. And that top line, that sort of teal color line, was the Spider ETF Gold. Right here, you see this is when COVID hit. And what people tend to do is a flight to safety. They view gold as a place to put their money to get some rate, and it did really well. I mean, it was as high as 30%, 30 plus, and then, finished up the year, somewhere around 16%, 17% in comparison to commodities, right? Which is this blue line here at the bottom, because this is heavily oil laden. But now if we go and look year to date for gold now, we see that commodities have had a robust year and a rebound, but gold, we're actually in negative territory. Gold is a unique asset. This is why I stress, and any financial advisor worth their salt, is this is not trying to pick one asset and bet all your money on it. And what we talk about is something called portfolio construction. But why gold in the first place? Well, gold, for those of you that don't know, is a relatively rare element on this planet. And it is in short supply, comparatively speaking. The cost to open up new mines and to mine for it, find it, and then ultimately bring it to market is expensive. And when California first detected gold, hundreds of thousands of people ran out there. And this was, I mean, think about it. I look at this picture and I was saying, just 170 years ago, we didn't have electricity, we didn't have cars. People wanted to change their level of life. They view gold, or they viewed this opportunity as a way to enrich themselves and to improve their lifestyles. Now, the woman in this picture is dressed very nicely. Maybe she's bringing these folks some lunch, but I look at this and I see backbreaking labor here. I look at this and saying, you know what, not only are they standing in water, hot days, I see pickaxes there, and I see, shovels and panning, right? So all of these things day in, in order to get out to California, so I have no idea where these people are from, traveled across the countryside, thwarted danger, Indians, hazard, weather, right? Sold whatever belongings, left whatever loved ones, at an opportunity to enrich themselves, and then go look for something with absolutely no idea where to look. But if you look at gold history, the California gold rush was from 1848 to 1955. And when gold was found by this guy, right, the news of gold brought roughly 300,000 people to California from the rest of the United States and abroad. But the sudden influx of gold into the money reinvigorated the American economy, and sudden population increase allowed California basically to go on the map. The gold rush had severe effects on the native Californians and accelerated the Native Americans' population's decline from disease, starvation, and the California genocide. This is just a little bit of history. So when you hear the commercials on TV, buy gold, buy silver, Roswell, Capital, whatever they're selling on TV, that this is the place. And last year, when everybody's telling you where to put your money, we have to start to think a little bit deeper than that. So what are some of the characteristics and the risk associated with gold? Well, first of all, a little bit of tidbit. It's element number 79 on the periodic table, and its symbol is AU. It's extremely heavy and cumbersome, and it's subject to theft if not guarded. I put that there because I have a client that has been a client of mine about 15 years, and I may have mentioned him before, and he's become a good friend. He and I have talked and talked, and he's signed up for some of these newsletters that the economy's coming to an end, that the devaluation of the US dollar is coming. So he has systematically bought gold. He's bought gold coins, he's bought gold bars, he's bought gold, he's bought gold, he's bought gold. And then he needed a place to put it. So he didn't want to put it in the bank, he put some in the bank. So he ended up sharing with me that he hid it throughout his house. And it wasn't just anywhere in his house, it was up in the rafters, hidden behind insulation. And I share that with you because these are the types of events that if he passes, I pass, 100 years goes by, a fire burns the house to the ground, somebody comes in, he forgets about it, somebody buys a house, and lo and behold, somebody does a remodeling job and finds it, and they're rich. To me, it's heavy, and it's cumbersome. But his argument is, hey, if we go back to gold and bartering and a gold standard, I need to have this. Okay, I'm not going to tell him how to invest his money. It's his money. But understand that's what people believe. And it is subject to theft. He was robbed. They didn't find the gold, but somebody, and I suspect it was somebody close to him, broke into his house and stole all his guns and firearms and knives, and they ransacked the place, but they didn't find the gold. So, it just tells me it's just highly risky. So, all right, so that's the risk, which is why people buy in other formats. It is highly sought. And as I mentioned, it is of scarcity. I mean, there's plenty of gold, but maybe not to the point where there's enough of it for us to meet all demands. Usually it's thought of as a safe haven as in volatile markets, as those slides that I showed at the beginning supported. And the US removed the gold backing standard in 1933. It was done by FDR. And the reason is that basically FDR put a moratorium on banks being able to give people were starting to hoard gold. They were starting to lose confidence in the US economy and their ability to be able to pay that their money to be worth something. So they put a moratorium, they detached it from the gold standard, and we're in our current environment now. It is usually an inverse asset to the stock market. So its counter or correlation is opposite of equities. Now it can be owned in ETFs. That stands for exchange traded funds, but you don't own the actual physical gold. Or you can look to buy futures contracts. There you don't actually own the gold, but you can actually barter on a contract where typically futures contracts and options trading, that's a conversation for another day. But you typically, right before delivery, then the contract is sold, and that's when you make your profit or your losses. Taxation. This is an area that a lot of people don't really give thought to, right? So remember that the US government, the IRS, says that all income in this country must be reported to the US, regardless of where you live. So if you make a profit on something, you must report it. Well, ETFs, typically equities are subject to what we call capital gains tax. And it was 15%, now it's as high as 20%. But gold ETFs are actually, if you hold them for more than a year, are at 28%. And if they're short-term trading, which is less than a year, then they can be taxed at ordinary income and even higher tax rates. So, you take all the risks. They're typically not income generating assets. You're buying it purely from its market value. And so the fees that are used to be able to transact these ETFs or holdings of that type, you have to be aware that that has to come off the top as far as the profits. Now, futures contracts don't have management fees, but you do have taxation as well. So just keep that in mind. I just wanted to put this out there. So when you're thinking about gold and thinking as it being the end all be all or the safe haven for short term, yeah. Having some of it, yeah. Part of your portfolio, yeah. But should it all your eggs be in one basket? That goes back to financial planning 101. The answer, in my opinion, is no. So this slide here really is a repetitive of the first slide we looked at year to date. It's just viewed differently. It's saying, hey, commodities have done really well. That's the top line this year, and gold not so much. This is just a different view of the data. Now, gold is an interesting asset because it has a low beta, right? And a low Sharpe ratio. It's a low correlating asset compared to other vehicles. So it gives it unique characteristics, some of which we've just gone over. Now, what this last slide is going to show us is that by just adding 10% of a gold ETF to a portfolio, significantly can lower the drawdown of a 60-40 blend type portfolio. So it's just showing you, hey, listen, balancing your portfolio by having a little bit of gold ETF is not a bad play. On a moderate portfolio, 60-40 split, having 10% in the ETF gold precious metal type environment wouldn't be the worst move you can make, and would actually diversify or lower your risk. That's what these slides were designed to tell you today. This is why the last thing I wanted to point out to you, because although gold, and a lot of you say, well, I'm somewhat familiar with gold. And, I had somebody that contacted mine last year. He was buying gold. He was all into trading and doing it daily. And I asked him, that was last year. I talked to him earlier this year, and I'm like, how's that going for you? And it's crickets, right? Because it's not doing so well, right? Now, the one that I always caution about is trying to bet the farm on the next hot item. I had somebody ask me the other day, like he got a stock tip on doing something. And I said, listen, most people that are giving stock tips are giving, misinformation or information based on an incomplete picture. In order for somebody to give advice, they really should understand your overall holding or all your goals collectively, right? So that they're not turning around, be like walking into a doctor's office and just saying, hey, doc, what's the matter with me? And he makes a prescription without doing any type of evaluation or diagnostics. It's malpractice. Well, it's the same thing in the financial services. So when you hear about Bitcoin, when you say, hey, listen, I think I should be in Bitcoin, or back in 2000, everybody was like, I'm going to be in AOL. It's splitting every day, right? That's the next stock pick. I have no horse in this race. If you want to own AOL, or if you want to own Bitcoin, or the next up and comer, right? Penny stocks that are going to go through the moon. The only financial planning advice, keep taxes in mind. Think of the tax environment that we're going to save, because if you're going to swing for the fences, this is the expression that I use, it's a baseball term. If you're going to swing for the fences, then we want to do it in a tax favorable environment. You want to hit home runs? Do it in a Roth. Do it in a Roth 401k. So that's our presentation today. Here's our disclosures. I didn't make up any of that technical terms. I didn't plagiarize ETFs or S&P or any of these things that you saw. These are my CYA statements, disclosures that I have to put out here each and every week. I look forward to bringing you content. Now, a little bit of a heads up. Next week will be September. It is upon us. Then I start traveling. With that, I want to tell you, next week will be, because September is Life Insurance Awareness Month, our topic, I am going to be going over the 10-minute lesson on life insurance. But the next 3 weeks after that, I'll be traveling, and then I'll be back on do a market update at the end of September. The last thing I just want to share with you, folks, I don't care what side of the aisle you're on. We're all Americans on this call. Please say prayers for the people that are over in Afghanistan right now. It's horrible news today. I'm absolutely beside myself. I'm a Navy vet. It absolutely breaks my heart to know that our fellow Americans who are trying to help people are being executed. keep your head on a swivel, keep your guard up, you know, hug the ones you're with, and because you stay safe out there. If I can help you in any way, please reach out. I look forward to speaking and seeing each and every one of you, and have a great day. Bye-bye.